Let's assume that someone's an employee now. The government takes your taxes before you even see the money, right? Versus if you're a business owner, it's a little bit different. I want to talk about that with you too. So if you already paid the money as an employee, are there things you can do, or should you do something else with their money, invest it to get the tax break somewhere else?
As an employee, you do have options, but they're limited. They're not like being an entrepreneur where you determine how much tax you want to pay. But as an employee, what you should do is try to find ways to generate losses, not monetary losses, but losses on paper. Ways in doing that are investing in real estate, especially if you're under $150,000 in income. Because if you're under $150,000 in income, you could benefit from real estate losses up to $25,000. Where if you're making more than $150,000 in income, you can't tap into those losses. You'd have to carry them forward. So what I would suggest is if you're making between $50,000 to $150,000 as an employee, maximize 401ks. Take advantage of HSAs that are offered by your corporation. Invest in rental real estate. Try to get financing where you could save some of your money, use that as a down payment, and leverage the bank's money to purchase some real estate. Rent those properties out, or you could work on flips if you're at that under 150,000. What's also beneficial is we believe as accountants, as tax advisors, entrepreneurs ourselves, even if you're an employee, you should have a side hustle. You should create a business. And what's interesting is there are no limitations on Form Schedule C. So if you're a sole proprietor, you have this passion of yours that, you know what, I want to continue working out at my job. I enjoy working for my company, but at the same time, I have a passion for helping others or possibly getting into a business that's similar to a hobby. You can generate income from this business, but more importantly, generate losses by starting to focus on your branding, your social media, your equipment, or some maybe technology expenses that you'll need for this hobby or business. And what's interesting is you can use that upfront investment. Let's say you invest $10,000 to $15,000 in this startup. You can use that loss in year one to offset much of your W-2 income. So the income that you've paid tax on throughout the year, between $50,000 to $150,000, you're paying tax on that dollar amount. But if you have losses through real estate or through a side hobby business on Schedule C, you can offset that income by taking that loss. But it's important to note that Schedule Cs are the most heavily audited tax forms. And that's another reason why the IRS, they put this microscope on self-employed individuals, where being self-employed is just maybe the introductory entrance in becoming a business owner. But if you're serious about doing business, you definitely want to take more of a legal approach and create a legal entity to separate yourself personally from the business.
Okay, so there's a couple things I want to dig into because there's a lot of value in what you just said. I want to talk about the real estate part, but maybe we'll save that for a little bit. What is a Form Schedule C?
So Form Schedule C is a profit and loss form that's filed on your personal 1040. Okay. So your business and your personal taxes are filed on one document. Now, you could be a Form Schedule C sole proprietor and still have an LLC. You're just a single member LLC.
Okay.
But the LLC is a disregarded entity. So the IRS still considers you the member and sole owner of your business. Now, we've seen Schedule Cs that generate $10, $15, $20 million in income. But that was a huge red flag to us. And for example, we had this client who was filing his wholesale business on his personal tax returns. And his net income would be close to $1 million a year. And we advised the client that, hey, you're overpaying about $30,000 a year in self-employment taxes. You've been a sole proprietor filing your business on Form Schedule C for almost 10 years. Like, you've paid over $1 million in self-employment taxes than you had to. And all you needed to do was file Form 2553 to elect to be treated as an S Corp. What's interesting as well is filing your business and your personal tax return on one document exposes you to more audit risk. So they are the most heavily audited forms with the IRS. And what the IRS does is when they see that your business and your personal tax returns are filed on Form 1040, they ask for personal bank statements and they also ask for business bank statements. But if you're filing as, let's say, an S Corp or a C Corp or a partnership, these are separate entities where your business is more subject to exposure.
So if I break that down, so if I wanted to go out, let's say I wanted to sell cupcakes, If I just started selling them to my neighbors, I didn't create any entity. I didn't create an LLC. I just went out and started selling cupcakes to my neighbors. And I invested $1,000 in getting the materials. I went to the grocery store, Walmart, and I bought some stuff. Now I take these cupcakes and let's say I make $5,000, right? So because I didn't create an LLC, so this is going to go on a Schedule C. Is that correct?
Correct.
And now if I said, you know what, I want to turn this into a real legitimate business, maybe I go out and create an LLC. Maybe I do it myself, I get an attorney. Now, if I create an LLC, this is not me, this is my business that's selling it now. You're saying that if I'm the only owner of the LLC, it's kind of the same thing from a tax perspective?
From a tax perspective, there's no benefit to creating an LLC versus just remaining as a sole proprietor.
Okay.
The LLC is beneficial when it comes to legal purposes and for accounting purposes. Priority number one is separate the entity for legal purposes. What if your neighbor chokes on that cupcake and she wants to come after your personal assets?
Yeah.
She's gonna come after your personal assets, such like your home. Not a friendly neighbor, right?
Yeah.
But if you separate and create a legal entity, now your neighbor can only come after what the legal entity owns and not what Jaspreet owns personally.
Sure. So now let's dig into the financial side. So now let's go through that same scenario. Let's assume that I make $75,000 a year. I spent $1,000 now buying this cupcake stuff, but nobody buys it. I lost $1,000 in this business. Can I take that $1,000 that I spent at Walmart getting my cupcake materials, maybe ran some advertisements or whatnot? Can I now tell the IRS, I spent $1,000 building this business, but I lost it?
Absolutely, absolutely. And documentation is key. So as long as you are actively pursuing creating a business and you document through itemized receipts, you can take that loss.
So this is where I think there's a lot of value now, because if I'm an employee, I make $40,000, $50,000, $500,000 a year. I think a lot of people nowadays, especially in today's culture, have some sort of side hustle, right? So if you're spending money on this side hustle, you're saying we got to keep these receipts. And then when we go to file our taxes, if we don't have an accountant, write these things down on something called the Schedule C and say, hey, IRS, I made $75,000, but I spent $5,000 in this business and made no money, or I lost $5,000. Now I can pay less money in taxes or get a bigger refund.
Correct. So as an employee, let's say you're on that $75,000 price point, you may not need an accountant that is providing you with monthly, quarterly financials, tax planning throughout the year, but it's important to document your records through a spreadsheet at the very minimum. Okay. Now, when you're actively pursuing this business, you want to document your mileage,
Mileage, like how much, what does that mean?
For example, if you're going to Walmart to purchase supplies for your business, that drive from your first business stop, so not from home to Walmart, but if you go to buy some pens or supplies from Office Max or Staples.
What about a cell phone for my business?
Your cell phone is deductible as well, the business portion. So let's say 50% of your cell phone bill, you use your phone to text or speak with clients 50% of the time, you can take a $50 deduction if your phone bill is $100 a month. So, and we could talk about, there are so many deductions that entrepreneurs don't even realize, or even employees, that they can tap into because they're actively seeking to grow a business. So as an employee, many employees are considered consultants, right? And the IRS is aware of this. But if you can document your cell phone bill, your automobile expenses, if you're driving client to client or customer to customer, or you're picking up some supplies, if you could document the supplies or even the meals that you have with potential clients or leads or vendors that you meet with, the insurance, some travel is also deductible. If you could document this, this is your golden ticket, because now the IRS, they're going to say you're innocent until proven guilty. So we're auditing you. We're sending you this letter that we are going to audit you, but we're going to request documentation. And if you beat them to the punch and provide them with the documentation to support your deductions and your losses that helped offset your W-2 income, which you already paid taxes on, which help you gain a larger refund that you could either take or carry forward into future years, you've done your part. You've given them the proof. They're not even going to waste their time at that point. And I'm speaking from experience. I've been through these audits. I know what the IRS looks for. And there are lifestyle deductions that you can tap into Because let's face it, the world has changed, and we're using our cell phones, we're using our vehicles, we're using our home, we're traveling a lot more, and you can take advantage of these deductions as well, as long as they're documented.
So this is super interesting because now okay, so I'm gonna go back to this cupcake example. So now if I'm an employee making $75,000 a year, what does it take for me to justify that I have a cupcake business? Like what if I say I wanna start a cupcake business and now I go out and buy the supplies, but then it's very easy to come up with a business idea and spend money, right? That's the easy part.
Absolutely.
But when does it take to actually qualify for the deduction?
Jaspreet, this is perfect timing. Yesterday, I received a phone call from a client out from New York, and they are considering investing in remodeling their kitchen. Mm-hmm. And his question to me was, Khalil, can I write off a portion of the remodel for this kitchen? And I said, well, for your company, you're not in the food or beverage industry. So unfortunately, there's nothing that you can really do to tap into your kitchen. Then he mentioned, Khalil, my wife is involved in this social media brand where she's helping people with autoimmune disease or other gut issues with a diet plan, meal prep, and consulting on ways where they can heal themselves naturally, holistically through food, as opposed to the medicinal route.
Yeah.
So when he said that to me, a light bulb went off in my head. I said, look, now we're talking. There's a portion that you can take. It has to be at least 50% for you to tap into. So if you're spending $100,000 on a kitchen, it has to be reasonable, ordinary and necessary. And it also has to be reasonable. Now, you can take, as long as it's documented, when you're creating content, when you are using your range, your refrigerator, your countertop, you are having clients or customers come to your house and you're feeding them or giving them a culinary experience, that's considered a business deduction.
So you're telling me,
you can tap into that.
I want to dig this because
it's a little bit more advanced than the cupcakes.
Yeah. So let's go and stick with that. I'm making $75,000 a year.
Right.
I have this cupcake business idea, but instead of just knocking door to door, I want to teach how to make cupcakes on Instagram and YouTube, right? So now you're saying if I want to upgrade my kitchen, this kitchen upgrade now can become a business expense?
So it's not black and white. Here's why. Because there's still personal usage of this kitchen. And if you're going to expense this kitchen through depreciation, if you sell the home, you're going to have to add back that expense that you took.
Okay.
So, but it could be beneficial in the short run. Now, I know many clients who say, look, times have changed. I'm working from home. I don't ever see myself working from an office.
Yeah.
So yes, I'm okay with depreciating my kitchen remodel or the business use of my kitchen remodel, and I'll add that back when I sell the home as depreciation, or I'll just, I'll take advantage of the fact that I can make up to $250,000 or $500,000 tax-free when I sell my primary residence, and if depreciation was $50,000 that I have to add back, it doesn't take over my tax-free incentive.
And depreciation is what? That means the write-off?
The write-off. So when you are investing in a fixed asset, you don't just write off the asset as an ordinary expense. It has to be capitalized over a specific period of time.
Okay, let's explain that now in English. So so depreciation, capital expense, fixed asset, what does that mean?
So if you're a business owner,
yeah,
you're buying equipment, you're buying computers, laptops.
And by business owner, you mean now whether I'm making 75 grand and I want to start a cupcake business or a real, like I have a business.
Exactly,
okay.
Exactly. This is just, we're talking about extra zeros, because at the end of the day, whether you're making 75,000 or 7.5 million, it's very similar. It's just obviously you have more leverage once you get to that level.
I see.
But when you are investing in remodels, construction, electrical, plumbing, any fixtures, you can't just write off the assets. They have an asset life.
Okay.
So for example, vehicles are written off over 5 years. Leasehold improvements like the moldings that you see here are written off over 15 years.
So if I buy a $50,000 car,
yes,
right, and I was going to write off 100% of the car, I can't take a $50,000, like if I made $100,000 this year, I bought a $50,000 car, I can only take a $10,000 deduction this year, $10,000 next year, $10,000 year after that. Is that what you're saying?
Unless you tap into bonus depreciation in section 179. So for example, for your cupcake business, you buy a fleet truck. Right? And it's advertised Jaspreet's Cupcake. when you're not going to drive this vehicle to a wedding, you're not
Yeah.
going to drive it hanging out with your buddies. This business vehicle is 100% business use.
Yeah.
You even have an oven in there.
Okay.
And you are selling, you started off with your neighbor, but
Yeah.
now you're driving around the neighborhood locally, and now you're selling your cupcakes door to door. That company vehicle is 100% deductible, and you could take bonus depreciation in year one. It used to be 100%, but now it's phased out to about 80%. So if the vehicle costs you $50,000, you could take 80% of that as a deduction in year one, and then capitalize the rest over 5 years.
So this is where it's very valuable to have a good accountant, because now I can see like a lot of people watching this saying, I need to go and start a cupcake business. But this is where things get very complex, right? Because now, as soon as what you were saying is if you file the Schedule C, you make 75 grand a year, you go out and start a business, and now you start taking your Walmart receipts and you use that to deduct your taxes, you open yourself up to potentially getting in trouble with the IRS. The way you protect yourself from getting in trouble is, number one, you document it. You get the receipts and you take notes on the receipts of why you bought it and what you bought it for. And then number two, I would assume as you start to grow, you get a good advisor accountant who can help guide you and track and manage and tell you how much you can deduct. Would you agree with that?
Absolutely. There are many levels to the time necessary to have an accountant. And that's factored by your revenue and the amount of pain that you feel paying taxes. So what's your pain tolerance?
Yeah.
I speak to business owners across the country. All of our clients are business owners throughout the country, and there are different levels. We encourage, so some of the phone calls we get are it's a complimentary call giving advice to people who are just starting off. And I have no problem saying, hey, look, at this time, you don't necessarily need an accountant. You don't need to have any tax planning yet. But there's going to be a time where we do cross that bridge.
Yeah.
But in the meantime, as an employee, you're making $75,000 or you just started your side hustle. Here's what I would suggest. Track all of your business income and expenses by creating a separate bank account.
Okay.
It could be a personal bank account that is separate from your other personal bank accounts where you pay all of your expenses from. But if you choose to create an LLC, that's kind of the beauty of creating an LLC, because you get to separate what your personal and business income and expenses are, and it's a lot easier to track for accounting purposes. But let's say you keep it a personal bank account where you could separate the income that you receive from customers and the expenses that you pay for supplies, gas, insurance, travel, meals, anything of that nature. Now, before having an accountant, before needing to have an accountant, check your bank statements on a monthly basis. You should check them daily, but as you grow, start checking them on a monthly basis. Start reconciling. Have an accounting software, or even use a spreadsheet where all the deposits that you're receiving are considered sales. All of the debits or checks that you write that exit or debit your account are considered business expenses. And track and categorize what those expenses are for. And at the end, you've just created a profit and loss statement that you could track throughout the year. Now, what's interesting is once you start making some money, you're going to have to pay quarterly taxes.
What is some money? How much money before?
Once you have a $1,000 or $1,500 tax liability at the end of each year, you must pay estimated quarterly taxes.
Even if you don't have an
Even
LLC?
if you're a W-2 employee.
Okay.
So for example, you're an employee and your employer didn't withhold enough taxes based on how you filed your W-4. If you owe more than $1,000 or $1,500 at the end of each year, you're going to have to pay quarterly taxes.
I see.
Or else you're penalized for it. So if you're a business owner, you're responsible now for your taxes. There's no employer who's going to be kind enough to withhold your taxes and pay it to the government on your behalf. It's your responsibility now as a business owner, regardless of how much income you're generating, to track what your income is. And so you track your income to figure out what your tax liability is. So let's say your business ends up making $20,000 at the end of the year. That's great for a side hustle. It's almost $2,000 extra, an additional supplemental income that you're making while you're still working full-time at your job. But what's important is that you pay your estimated taxes based on the federal income tax, your effective tax rate that you owe, and also what your state income tax rate is. And then you would pay those taxes 4 times a year throughout the year. And then when you file your taxes, it's important that if you're going to file your taxes on a software yourself, that you include what you've paid throughout the year. Or if you're going to meet with an accountant, you bring your spreadsheets that you've worked on throughout the year,
Yeah.
the receipts that you documented throughout the year,
Yeah.
and you're also going to provide them with the liabilities the payments that you've made throughout the year, so they factor that when preparing your taxes. But that's the bare minimum elementary phase in starting a business. You need an accountant once you're making more than $250,000 in gross revenue. That's where it makes sense to invest in a team where now you don't have time to track your revenue and your expenses and your assets and your liabilities. Your goal as a business owner is to hire the right talent around you so they advise you on what you need to do based on your financial reporting, and they would discuss the data, the balance sheet, income statement of cash flow. They would provide those to you on a monthly basis. They would meet with you each quarter. You would tax plan with them, because at the end of the day, when you have an advisor on your team, as the CEO, you want to hire the right talent around you. They are reporting their findings to you as a CEO. So I would say, Jaspreet, here's what our findings are for this month. Here's what our tax liability is going to be for the quarter. Here are our recommendations in ways where we could reduce that liability.
Yeah.
So I feel like if you're under 250, you can handle it yourself. Be organized, track your data, track your business income and expenses. But once you're above that threshold, it makes sense to maybe outsource this to somebody that you could work with. You're not out of pocket the purchase price of the home. You finance, hopefully with good terms, you finance the property. So let's say you have a $10,000, let's call it one rental property, and you have a $10,000 income, but your depreciation is about $10,000. It wipes out your income. So on paper, you'd have no income. You just generate